Association of Financial Advisors of India. Knowledge series in association with Resurgent India ICICI Bank presents a virtual seminar on solutions for hedging and managing Forex. Moderator Mr. K.K. Gupta, Director, Resurgent India Limited. Mr. K.K. Gupta is the Director at Resurgent India Limited, specializing in corporate finance and management consultancy for SMEs as well as large corporations, handling substantial financial transactions. He also serves as a task force member for government MoUs and on the grievance committee at Power Finance Corporation. With a 36-year banking background and a tenure as General Manager at Central Bank of India, he holds degrees in economics and bank management. Key speakers: Mr. Gaurang Vaswada, trainer, ex-banker and partner, FEX Fin Associates LLP. Gaurang Vaswada is an ex-banker with over 37 years of experience, having worked with the Bank of Rajasthan and ICICI Bank. He holds an honours degree, KEB, and multiple certifications from IIBF. His expertise spans trade finance, Forex treasury, and trade compliance. He has held senior roles including Head of Forex Treasury and Head of International Banking at the Bank of Rajasthan and SME Trade at ICICI Bank. Gaurang has been a resource person for the Indian Institute of Banking and Finance and has conducted extensive training for bankers and exporters post-retirement. He has spoken at over 90 seminars organized by FIO and is a guest faculty at various institutions. Gaurang is also a partner at FEX Fin Associates LLP, specializing in FEMA, export, import, trade finance, and trade compliance consulting. Ms. Saranya Kaleswaran, Trade SME, ICICI Bank. Saranya Kaleswaran is currently the subject matter expert under Trade Division at ICICI Bank. She has done MBA from BIM Trichy, 14 years of experience in trade.
Good afternoon, friends. I am K.K. Gupta, your host of this program. I am a Director of Research in India Limited and Director of Association for Financial Advisors of India. We are happy to announce today virtual webinar on the subject solution for hedging and managing Forex. We are going to discuss the risk in international business, foreign exchange risk, impact of foreign exchange risk, factor of exchange rate movement, and tool to manage foreign exchange risk. I think these are the main subject which we are talking to you. And our main speaker in the program is Gaurang, who is a trainer, ex-banker and partner of FEX Fin Association LLP. And we are with us Saranya, who is the AGM of ICICI Bank. This program is sponsored by ICICI Bank with the Association for Financial Advisors of India. And you know that we have, under the banner of the association, we conducted about 44 webinars. This is our 45 webinar with different subjects, including the SME sector, including the foreign exchange, export finance, and infrastructure, and even the restructuring of the SME accounts or other accounts. We have done so many webinars. And under the banner of the Research in India, we conducted about 221 webinars on this subject. Today, we are happy to announce that we have more than 400 registrations with us who are participating. Those are our members of the association and also entrepreneurs, and also some bankers friends are also here who shown their interest in the subject. So we will talk in a discussion in respect. You must have seen today's paper where they had tell about the exports. Outbound shipment at 3 months high. Trade gap at 7 months recorded. And India goods export rose by 9.1% for 3 months high of $38.1 billion in May, outpacing the import from growth 7.7% on the higher base of 61.9 billion. The trade deficit jumped to 7 months high of 23.8 billion. That means export has a very important role to have a deficit in the trade finance. So we are talking to you, and the main risk factor which we are going to discuss with you the hedging, solution of hedging and managing the forex. Now we are with us, Mr. Gaurang, who is expert under the field, who is going to talk to you risk in international business. What are the risks in the international business? How you can hedge it? I think this is a more important aspect. I will not take much time because time is very short, 1.5 hours, which we have covered all important aspects. And as when desire, we will discuss with interact with Mr. Gaurang regarding the aspect. And ICICI expert will also highlight how the ICICI Bank is helping the entrepreneurs in export finance, because export is a necessity for the Indian market. If our India want to grow, that means export has to grow. So we have to tag our deficit, but we are talking about 7.1%. I think we should reduce to that, although we are meeting from inflow of the foreign exchange from other sources also. So I'm not taking much time. I'm requesting Gaurang sir, please give your thought on the subject. And we will talk to you as per your when you move with your presentation. Any question from my participant, please free to ask us. You can ask one question, so we can give a reply to all your question. All clarification can be given to you. I request Mr. Gaurang sir to please go ahead with your program, with your thoughts. Gaurang sir, please.
So thank you, Mr. Gupta, for the introduction and putting the rolling out the ball. I must thank IFAI and Research in India and ICICI for this opportunity to interact with large number of listeners across all channels and including this webinar. Now, while I'll share my presentation, one thing which Mr. Gupta has said that the numbers in today's newspapers that our May numbers have improved. But I would like to put a note that we are around $460 billion of export of goods in the year 23-24. And our target is 1,000 billion of goods exports by 2030. Similarly, we are around 270 billion in services, and our target is 1,000 billion. So $2 trillion of exports we are targeting by 2030. I must greet and I must maybe acknowledge the efforts being made by the AFI and Research in India in organizing such seminars. Because when we are looking at touching a huge number, the understanding level on all topics, including compliances, finance, exchange rates, etc., will have to be understood very thoroughly to safeguard our bottom line, firstly, and to see that we are growing in that direction, the direction which the government has set for us. So I will just load the screen. One second. Yes, is it visible, sir?
Okay. Go ahead, please. Please go ahead.
So here we go. Now, as said, I'm going to cover various risks in international business, something about foreign exchange risks, what risks are there in the flows, and what are the tools to manage that. And after my session, and even after the presentation from the bank side, which Rana is going to take, we will take all your questions. You can keep ready, note down those questions. Now, when we talk of exports, even before any type of risks, the first thing which comes to my mind is the buyer identification. Your buyer, if you are able to find a good buyer, you are able to do proper research on your buyer, then half of your tensions, half of your risks are already gone. Spend enough time in buyer identification, try to find out more details about the buyer, try to find out from the market, try to get ECGC, Dun and Bradstreet, or maybe BIRA reports from any other agency on the buyer. See that he is well established in his field. He is not an overnight operator that he gives an order to you. And because we are every month getting one or two queries in such a way that first order gone bad, first order having reached, the buyer has vanished and all those things. So please try to make more efforts here. The next is creation and construction of an order. Now, for me, when the terms are finalized, though all those terms need to be put it on paper and signed by both the parties. This document, once signed by both the parties, becomes a contract. And when this becomes a contract, if any breach is there, at least some document is there signed by both the parties, which you can take to court or the other party can take to court for that matter. So order has to be robust and several terms. Now, even maybe as recent as last month, somebody showed us an order where we did not have an INCO term. Now, we have started sowing the seeds of a dispute when we create such an order. Then, of course, logistics, shipment, Red Sea, all those issues will be there. And finally, what we are looking for at the payment side. So our foreign exchange risk will culminate at the payment, but it starts from the time I identify the buyer and maybe create an order. Now, to take this forward, we will discuss or what risks will impact the export is the credit risk, shipping risk, country risk, IPR risk is more important now. Maybe documentation and legal risk and forex risk at the end. But one item on the side is order. So I just added two more items here saying that how and what is to be seen appropriately in an order. It is not only the price, quantity, terminology, or maybe brand name, some maybe marks what you are there, and then maybe there are multiple items. So maybe your sizes, color combinations, all those are there. But order should also have your order should also have the combination of the Incoterms and the legal terms. The legal terms meaning that what in case of dispute, what will be the legal place? What will happen if there is a event like COVID? What will happen if sanctions are there? What will happen if I am unable to execute the order? So force majeure conditions are there. What will happen if an additional export duty is there on an export side? Suppose there is an additional export duty imposed by government of India. Who is going to bear? So we saw for non-basmati rice, 25% of the duty being imposed by the government. Now, if my contract is say for $400 and if 25% is there, I am earning, whether I am earning that 25%? No. So I'll have to put in certain conditions in between, say all those eventualities which I am not seeing now. But it may come in picture, maybe licensing requirement or some specific approval requirement. Then the shipments could be delayed, the pricing could change, etc. And if this condition like Red Sea happens, where we do not get containers and the shipping line costs are now exorbitant, our order is not made for such an event where we could absorb such things. So our order is more important here. Is one I wanted to emphasize. Now going forward on the risk side. So before going on the risk, we will see who is affected by the forex flows. So for forex flows, everybody is affected. Even me, you, or any common person. So travelers, investors, residents, non-residents who have some interest in inflow or outflow, they will be affected. Then the corporates, of course, or the companies or businesses where exports, imports take place of commodities, services, software, etc. And investors and multinationals, these are big bigs. They are into corporate investment abroad, maybe corporates here investing abroad, then putting up plant in Malaysia, Thailand, or any other countries, or some large corporates putting up plants here in India. Then the multinationals who only look at the opportunities and flow the money from the lower returns to higher return areas, and maybe the opportunities they look for it. So they are all impacted. The lenders and borrowers, we are borrowing ECB day in and day out. Our exporters are able to lend to their associates abroad. And what all these things are there which will impact us. And a big breed of arbitrageurs and speculators. So this is one breed which moves the market, which forecasts the market, which sees, so maybe around 95% or maybe 92% of the flows in the market are all impacted or are all contributed by the arbitration and speculative. Now, this all inflows and outflows could be by way of our income or expenditure, maybe revenues or expenses. Now, revenues could be interest, it could be maybe dividends, it could be our revenue or received by way of exports, payments by way of imports, non-import payments, and all other inflows and outflows like ECB, FDI, ODI, etc. And people who are involved directly or who are not involved directly are all impacted by the movement of foreign exchange rate. We know if the rupee is at 80 rupees, the petrol cost of the petroleum products in India would go down, and hence we can expect that the prices would go down. So if the prices go from 83 to 85, definitely the cost of petroleum product would increase, and it will impact everything right from transportation, bus fares, rail fares, etc. Now, beyond those who are actually into the trade or foreign exchange, who are handling foreign exchange or who are requiring foreign exchange, besides that, domestic manufacturers who are using imported raw material. So that will impact my domestic production also, because if I am an imported raw material, definitely it will impact the cost of overall production and hence the price of the domestic product. Or otherwise, the domestic users of commodities, even if I do not use imported raw material, but I use a domestic raw material, but my competitor uses imported one. Now, suppose the imported one gets cheaper because the dollar rupee has gone from 83.50 to 82. In that case, that 1.5 rupee difference will reduce the cost of production for my competitor, and hence he will compete with me by offering 1 rupee lower per kg or so of the material which is producing in India. So it will impact all sides, domestic manufacturers who is using import or non-import user domestic manufacturer also. When we talk of order, the important aspect is use of Incoterm. And I said that even now we can sometimes find out the orders where Incoterms are not there. So what is those international commercial terms, the product by International Chamber of Commerce? It lays down or standardizes the responsibility of buyer and seller, the point of transfer of goods, at what point the ownership of goods is transferred from seller to buyer, and allocation of cost. Now, when this is decided by way of using this three-letter term like FOB, CFR, EXW, CPT, etc., I am more or less sure, and I can say that if I use X words, where my responsibility ends and where will I give the transfer or the ownership, or what is the cost which I have to pay. If it is FOB, then it goes up to the port. If it is CIF, then the cost is borne up to the end point or the destination. So correct use of Incoterm is required. Now, one more item here is that whenever Incoterm like FAS, FOB, DAP, X works, etc. is used, a place should always be there. So if I say X works, my factory in Pune, or X works my godown in Thane, I will have to mention where the buyer has to come and collect the goods. If place is not there, then you are doomed. So if I say FOB, then FOB which port? CIF, then also port and destination is required. So it has to be placed there. Other one important item which I thought that I will bring in because it is also impacted, it is also affecting the risk part. That Incoterms, while they are standardized terminology, but they do not cover major of the things which should be there in our contract. So very specifically it says Incoterms do not substitute the contract. The contract is in its place. I have my own terms and conditions of sale, the quality, the specifications, etc. And it does not cover specification of goods, time, place, method, and currency of payment. So I'll have to mention how this is to be paid, what currency is to be paid, and what is the method to be payment, whether in my Nostro account or in rupee converted. The remedies which can be sought in case of breach of contract. Now, even this should be there. What should be the penal action if there is a breach of contract? The effect of sanctions. The geopolitical situation is worrisome. And because of that, I also need to put in that if there is a sanction, then how do I manage that or how do I handle that? The imposition of taxes by either of the country. If I have said GDP, now if the buyer's country imposes a duty, import duty, or it increases the import duty, then what happens? I will be doomed out. Export and import prohibitions, force major or hardship, and IPR related. Now, IPR related also is very important. While IPR registration takes couple of years to get in each country, but still I must mention what do I want from an IPR and what will be the breach and how the breach will be treated. The method, venue, or law of dispute resolution in case of. Now, in a domestic invoice, we normally mention subject to Rajasthan legal or maybe Delhi court or Mumbai court, etc. But in international, sometimes we forget to put this. Whether I want that to be legally arranged here in India, or I will go to Dubai, or I will have to go to London or the buyer's place. It is a challenging aspect. So these two aspects relating to Incoterms, what exactly it should be and what it does not include, should be covered. Now, going forward, taking for the other risks. So the risk was relating to the order and what should be included there. Now, when we talk of international business, the risk will relate to credit risk. Now, credit risk is what? It is as good as a bank sanctioning credit limit to an entrepreneur. When I am giving to a buyer on credit, 60 days credit, 90 days credit, 180 days credit, it is that I am giving him a usance period and a tenor to pay out after a certain period. Even the buyer not taking up a side bill is also risky. So I must assess the risk, not put all my eggs in one basket and distribute it. So when the entrepreneurs talk to us, or normally when I suggest them, I say you start with one country and one buyer. Try to find out a second buyer in the country within a short time. Then move to another country also, because even if one country is not enough highly rated, then you are put at risk. So credit. So I will, if I were a businessman, then I would say that, okay, if I am to do a $10 million transaction, then I will not do a one single $10 million in a year with one customer, but I'll try to spread it out in 3, 4 customers, maybe in one country or more than one. And cargo and shipping this. Now, this normally happens that we have our factory insured, godown insured. But what about the insurance when the goods leave the godown and they are in the transit to a port, and from the port they are in a transit to the buyer's country? Now, we have seen people are happy when they say that FOB is a good term, sir. I am not required to bear the cost of insurance. But who has done the insurance? Ultimately, until I am paid, I am at risk. So whether the buyer has done the insurance or not. Or another example is that there was a CIF contract where the insurance was done from, say, Nhava Sheva port to Dubai port, Jebel Ali. But when the goods traveled from Bhiwandi to Mumbai, that leg was kept uninsured. God knows why. And if some fire happens or the truck downturns or some accident is there, then that event is also open. So the cargo should not remain uninsured even for a minute, even for a mile, even for a meter. From your godown till it reaches the place or whatever as per the Incoterms your responsibility is, that time it should be there. Even if the insurance is on the part of the buyer, you should see that it is insured. Country and political risk. Now, putting all eggs in one basket. We have seen people who were dealing only with Russia all through, and maybe in 2022, how they were impacted all of a sudden for 6 months, all uncertainty, payment nahi aa raha hai, payment nahi aa raha hai. Or people who are only dealing in Sri Lanka, or people who are currently dealing in Bangladesh and facing a lot of problem in getting payments, even for an LCs. So those places, we must diversify. We must see that the country ratings are slightly better. And I should be able to find out one good country and one medium range country should be okay. But all my exports in 4 bad countries or 4 red mark countries or amber mark countries should not be there. IPR related. Now, IPR registration is a long drawn process, but still, I must safeguard, I must keep a watch, I must have some review relationship, or maybe try to see that my IPRs are not copied by the person at least whom I have sold my goods. And we also know that there is a process by Government of India where IPR related registration costs are reimbursed up to a certain extent through our export promotion councils. But that may take 4 years. But till that time, we have to keep a watch on that. Documentary risk and legal risk. Now, the laws in each country are different. But we have shelter of the Incoterms, we have shelter of UCPDC, we have shelter of URC, and we also need to take shelter of the documents which we are preparing as per the requirement. So, preparing documents under an LC, while UCPDC is there to shield us, but whether the documents have been prepared as per the required conditions as per international terms or not. Another aspect is that if we are not able to handle the documents or prepare the documents as per LC, then be sure that LC will become a least secured or most riskier instrument. Then lastly, the formations. So the first 4-5 risks are all those risks which I need to take care while finalizing the buyer, while finalizing the order, while making shipment, and while making the documents. But when I talk of our ultimate goal is what? Realization of funds. So the foreign exchange risk would come in play, and we will see now what all things will impact the foreign exchange. Now, foreign exchange risk is what? A pricing risk. The risk will start right from the time I quote till it is converted and paid to my account. My books are all in rupees. So till it is converted and paid, till that time, the pricing risk would always be there. Why? Because the movement in prices or the volatility in exchange rates. Exchange rates, what we call, is a pair of currency. INR by itself is nothing, no exchange rate. 1 rupee is equal to 1 rupee. But when we take it a pair, INR with dollar or INR with Japanese yen or INR with ruble, then that rate would be there, and the movement in prices within these currency pairs will impact the pricing or the realization from the time I quote till it is credited to my account in rupee. Now, currency is how much volatile. Major currencies like pound dollar or euro dollar or even yen dollar, dollar yen. The price changes every 3 to 4 seconds. Every 3 to 4 seconds it changes. Maybe changes are more in a minute. It may go up and come down, or maybe it could be up, down only, but it changes. No other commodity in the world changes that fast. So the volatility index could be more impacted from the currency exchange risk than even our gold, oil, or any other commodity. Because of the overall cash flow gaps, I am receiving money today and I am required to pay after 15 days. In 15 days, the scenario changes, or even 5 days, the scenario changes, or even tomorrow, the scenario changes. The cash flow gaps also could impact my overall pricing and the cross currencies, those currencies which are not directly quoted. So when I talk of rupee, it is directly quoted by US dollar rupee. $1 is equal to so and so. But if I have to take a price for euro rupee, then I have to go through dollar rupee and euro dollar. It's a cross currency. Now, when I talk of dollar rupee, I'm only talking of 2 currencies, 2 economies, 2 strengths or weaknesses, 2 interest rates, etc. When I talk of euro rupee, then I'm also talking of eurozone strength, weakness, interest rate, dollar, strength, weakness, interest rate, and the pricing, and also the rupee strength, weakness, and pricing, interest rates. So I need to go for hedging or any other tools. So hedging, some tools are there, but other aspects also I will take. So my major emphasis today will be on other tools, what is there, and then we move to hedging. So some of the charts I just thought that I'll put and show you. Dollar rupee 1 year chart. So maybe if I think that from this place to this place, the movement is not there. But I would be lucky or unlucky if the price is here when I get the money, or if I get the money when the price is here, but when it is converted, it comes here. I booked an order when the price was here, but when the actual shipment and payments were started receiving, the price came here. The impact of a rupee or so there, or more than that, 1.5 rupees. So this all will depend what chances I want to take, or whether I want to take chances. The next is 1 month. So this was 1 year. The next is 1 month. Even in a month, shorter duration, you can see the currency moving from 83.001 to 83.60 plus, even in this month. So if I start shipment here at maybe around 25 paisa or 30 paisa, but one of the payments received is here, another shipment goes here, payment received here, another shipment goes here, payment received here. Even that 20-30 paisa difference make an impact. Now this is euro to dollar when we talk of cross currency. The currency has moved, not moved much. The impact is only 0.45% during a day. It is a daily chart. But the daily chart means that it will impact 30 paisa if I extrapolate this with dollar and rupee also. The euro INR 1 year chart is 1.74% on a monthly basis. The range from 87 to around 91, 92. So who is impacted? We have just closed this. I think this is the repetition, so I will move forward. Now, what factors are there? So it could be fundamental factors relating to the economies, the countries, for US dollar and India for Indian rupee. So the balance of payment, economic growth rate, uh, fiscal and monetary policy, interest rate scenario, and political issues, stability in politics and policies both. If somebody forecasts the growth rate of maybe next 2 years at 6%, it will show the weakness in the economy, because we are looking at 7.5% or so. The world over, it's thought that 7.5% should be the growth rate for India for next year, or even one more year after that. And if the forecast is changed, or the actual growth rate in next 6 months is around say 6%, then the demand for pulling the dollar back out of the country on one side, or getting additional inflow on the other side, will be weak. So inflow is weak, or demand grows for maybe pulling the dollars out of the country. Both will impact weakness in the rupee. So dollar rupee would move from 83.50 towards 85. If the fiscal and monetary policy, one by government, one by Reserve Bank of India, if there is too much upheavals there, too much uncertainty is there, or maybe every monetary policy meeting some major drastic changes and then reverting back, everything is there, then it is a difficult situation. And too fast the growth of interest rate, or increase or fall in interest rate. The last part, in my view, is more important, because the stability will also impact all the above aspects. Stability in politics and the policies of the government. You compare the thoughts in the minds of several people as of 1st June or even prior to that, then on 1st June, and then on 4th June, and maybe then on 11th June. All aspects, all thought process in the minds of people have changed, and we are rather sure that the policies are not going to have drastic change. The government, whatever be the maybe construction style or pattern, etc., the policies are going to remain stable, and whatever path we had chosen for last two regimes, that is going to remain there. Then the fundamental factors are strong. We are going to get the money. If we are going to get the money, the chances of dollar rupee remaining at this level or maybe slightly getting stronger, rather it going towards 90 or less. The technical factors, unrealistic value of the currency. Maybe if we peg the currency, if the government tomorrow says that I don't want the currency to go beyond 84 and below 82, sorry, 82 and 84 is the band there. Then we have seen this in case of China, we have seen this in case of Hong Kong also for several years. Then if there are restrictions, changes in the policies of freedom and restrictions in movement of capital, you can bring in the money, but when you go out, you have to stand in queue. Nobody will bring in. Huge surpluses. The reasonable reserves what we have is 630-40 billion right now. But look at a scenario where the reserves are 1,000 billion plus or 1 trillion plus. For an economy which needs more investments, does it augur well for us to have huge surpluses or huge reserves? That's another question, and that could also impact the faith of the overseas investor in India, and because of that, we may get more of the flows. Sudden large flows or inflows or outflows. Maybe I was yesterday only in this on the same subject in the seminar. I was talking that a large IPO was there, and with that IPO, it was announced that some $1 billion, so $4 billion is likely to come in. Now, when you talk of $4 billion subscribed by foreign institutions, that money is required to be brought into India, then what happens? Large inflows are there. So maybe Monday markets opens 20 paisa stronger, 30 paisa stronger. And maybe after 5 days, it may come back. But at least for a shorter duration, these inflows and outflows make impact. And lastly, the speculation. People who move the market by way of their understanding of the market, the expected movement in demand and supply due to expected future price, expectation of revaluation, devaluation. And this word is a trading, which we call it trading, taking view on the currency prices. All institutions, including banks, have their proprietary trading desks besides. So the trading is what it gives the depth of the market. There could be two-way quotes only because people are there into trading. And as I spoke that maybe out of the $4.5 trillion market, which every day it is transacted, maybe 92% or 93% of it only trading. Only the 7-8% is business or actual flows or actual lending volume. Now, the exposures what we have is transaction exposure. Transaction exposure consists of my pricing at the time I have quoted, so my costing rate and the actual realization. My costing rate is 83 rupees. When the order was there at 83.50, when realization came, the dollar rupee came to 82.50. All of a sudden. So the difference, so it's a transaction related. And translation, because all the companies, corporates are now required to translate their exposure every quarter, every balance sheet date, and maybe mark up or mark down their assets and liabilities in foreign currency, including the exports import. So that is all as per AS 11, I understand, of the CNC. And the economic indirect effect due to change in rates, change in price of raw materials, maybe we talked about the petroleum prices, etc., competition from international suppliers and all those. Now, with this, all three exposures impact the bottom line. And that is why we should manage whatever we can manage. I cannot manage the economic exposure or the price of my competitor or price of the other party with imported raw material, etc. or somebody from Taiwan who is competing against my export business, or from Bangladesh. But I can control whatever I can. Now, stages of transaction exposure. At the time of conception, when I quote, when I bid. So whenever I'm bidding, normally I will keep certain margin. So now exporters are bidding, say, by taking rupee at 80 or 80 to 50. But if I take it at 80 rupees, I may become uncompetitive. So I'll have to see what's the best cushion I can keep. What are the chances that the dollar rupee would go at 82 or 80 or 79, or maybe I can very well think that I'll be able to book a contract at 83 only, not below that. So I can keep at 83. Now the decision of this quotation will impact, because ultimately if I am uncompetitive, I'm not going to get an order. If I do not get an order, then all excess goes off. Then the birth. Birth is what? When I get an order. So even at the time of order, if I have taken 83 rupees and at the time of order it is 80 to 75, I can very well say that even at 80 to 75, if I can book a forward contract at 83.50, then still I am gaining 50 paisa beyond my bid rate. Or even if it is 83 at that time, then 83 plus 50 paisa premium, if I'm able to get for 4 months or so, that should be good for us. Uh, then the anniversaries, the translation related assets or liabilities I need to translate. So these are all temporary losses, and I have to book it on the, because it will impact my bottom line, my profitability, etc. For a day. 31st March I book, and 1st April or 2nd April I reverse it. And the depth of the exposure, when the culmination is there, the closure is there. So at the time when the actual realization is there, at what rate it is getting converted and getting into my account is the culmination of a contract. My objective is optimization of profit. I am looking at if I am pricing a commodity at 83, I am looking at increasing some margin by way of exchange benefits, optimization of profit. The best rates I should get. The best rate does not mean greed. You have to take out greed out of it. Then I also use the risk management tool as an insurance to hedge by booking forwards or options, etc. And all this will depend upon my risk appetite. If I get an order where I have a 40% margin, I can put 10% of the margin at risk by not booking forward contract or by keeping my positions open. Now, for a large corporate, there could be an annual budget on the plus side, minus side, costing rates, forward rates, and burn strategies, etc. Would be there. We'll see some of these in the later part. How to manage foreign currency accounts? I can put risk limits. I can have the set off process, the borrowing in the currency of invoice, other aspects and hedging tools. So I think we'll see one by one. We can use any one or a combination of the tools based on the size, nature of unit, etc., and the capabilities what we have. Okay. So foreign currency accounts, the basic account is the EFC, Exchange Earner Foreign Currency Account. Now, if I am seeing that because of certain regions, the dollar rupee is going to go to 83.70 next week. And if I have received a payment maybe last Monday, where the rupee rate was 83.30. So instead of keeping the money in my current account, INR current account, I can park it in EFC account and wait for a couple of days to see if I am able to realize 83.60, 65.70 or anything. Anything beyond the rate on which I received the money. What is it? In current account, I am not getting interest. In my EFC foreign currency current account, I am not getting interest. But what I can get is additional 10 paisa by way of holding that currency for a day or 4 or 5 days in that. On the other hand, I can keep this money for a month or so. I can keep this money if I receive it today, maybe on 14th of June if I receive. I can hold this money up to 31st of July. Maybe the July last working day should be 31st only. Yes, 31st is Wednesday. So 31st July is the last. Now, if I am able to hold this money for 1.5 months, I can keep the position open and look or watch for the currency to move in my favor during this period. Or I can book a forward contract. I will sell these dollars on value 31st of July, and maybe today's rate plus 15 paisa, I am able to get a premium on that. So anyhow, I am instead of 30 paisa, I am getting 55 paisa rate as of today. The position is locked, but I am able to make 15 paisa out of it by just putting that money in EFC account and booking it. Now, this account can also be used for outward remittances. I have an import payable after 7 days. I have an import payable maybe in the month of July. I have an import payable in the month of September or in February 25 or subsequently. But it should be a crystallized payable. The due date has to be there. Or if I have an ECB payment, the installment of ECB has to go in September, December, June, September, December, and March. If I have balance, I can earmark that and keep it for more than that period. Otherwise, I have to convert it on 31st of July. Now, by either holding for a shorter duration or a medium term or otherwise, I am saving on exchange difference, which would have paid today and on the import side, or the margin which I would hold. For SEZ units, an improved version of EFC is special foreign currency account where the mandatory conversion is not there. So ideally that can be used for all inflows, outflows. For diamond dollars, diamond dealers, it's a diamond dollar account. Up to 5 diamond dollar accounts are permitted, subject to certain conditions. Then accounts by shipping lines, airlines, or their agents who are collecting money here, maybe in foreign currency from their constituents and then remitting to their principal abroad, or the foreign airlines agent here in India or in Indian airlines foreign agents abroad, everybody is allowed there. And then when I go abroad for exhibitions, etc., I may sell goods there, so I can open a temporary accounts abroad, or I can also open accounts abroad for my offices abroad. Now, accounts are also one of the smallest tools to manage risk. Not converting into rupee in a haste. I will have to calculate the interest rate if there is anything on the rupee. If I am maybe availing cash credit, then I will always calculate that 10.5%, 11% interest. The other is putting in place risk, country risk. Now, how do I know countries? So maybe countries, I can see that what countries are from ECG. Now, ECGC publishes a list. You can take it from ECGC's website. Every quarter they update it. So there are 7 parameters. Least risk, then medium risk, maybe A, B1, B2, C1, C2, and D. So A1, A2, B1, B2, C1, C2, and D. So D is strictly prohibited. Maybe if I were to start business, I will not start with C1, C2. I may start with B1, B2 or A1, A2. So reasonably good countries. I will not put all my exports into one country, which is C1 or so, or D2, C1 or even B2. So let us see that country-wise also I disperse my risk. The other is that currency exposure relating to country. So if whether I'm drawing all my invoices euro and euro is too volatile, or am I drawing my invoices all in what you call Japanese yen, and Japanese yen is too volatile. So I'll have to pick that also. And then client risk, that is the credit risk. Putting ceilings on the drawings or exposure taken on each client. So dollar versus non-dollar exposure, that will impact my cross currency risk, or that I can control through my product. The other is set off. Now, many of the industries import raw material from party A and maybe value add here and then send the finished goods to same party abroad. There are many units here in SEZ, many units here in DTA who are doing this, getting raw material and maybe doing processing, job work, etc., and then sending goods. I need not pay for my imports and I need not get full payment for my. This could be vice versa also. So set off provision says if the transactions are with same buyer and the seller, and the shipments are done in same calendar year, both import shipment and export shipment, I can receive or pay only the balance amount and thereby ask my bank to close the bills. So $80,000 bills goods imported, exported for $120,000. There is no need to receive or pay 80,000. I can receive $40,000, give the documents to the bank along with some declarations, etc. And then those can be closed. I will also be able to get bank relation certificate for $120,000, even though I have received $40,000. Only where exports and imports are from same overseas party and the shipments are in same calendar. Now, slightly improved version for SEZ units, net off. There, the same calendar year condition is not there. And they are permitted to net off their export receivables against import payables on a balance sheet date. So it could be a quarterly balance sheet or half yearly balance sheet or annual balance. Borrowing, I have a euro invoice in export and I am preparing goods and I will be making shipment in 90 days and then after 90 days I'll get the payment. So I have an exposure in euro rupee for 180 days. If I am taking limits in rupee, I am using the credit in rupee, then my exposure is for 180 days in euro. Better I can ask BCFC in euro itself and sell that euro today. I am hedged. I know that I have got 80 rupees or 85 rupees or 90 rupees, whatever is the rate. So borrowing in the currency of export can also be used as a hedging tool. Similarly, while forfeiting and factoring on the post-shipment side, the factoring agency pays you 80% now, which you are able to convert today itself. When you get 80%, your 80% risk is gone. Only on 20%, which is the residual money, that your exchange risk will remain. Now, if the transactions are for huge value, maybe $2.5 million shipment is there, then this 20% equivalent will also be $5 lakh. You can hedge $5 lakh, or you have an approximate idea that around 8% value will be reduced. You hedge $4,500, $4.5 lakh. Sorry. Then on the import side, buyer's credit. I find the dollar rupee too volatile now, and it is maybe hovering around 83.50 or moving towards 84. But I feel that after the government is settled in 90 days period, it will come back to 83, or I will get a chance to book at 83 sometimes. So I can take a dollar loan for my buyer's credit, pay my supplier, and defer my payable for 90 days, and thereby get a chance to book my contract within that 90-day period. Also for my overseas venture, when I'm maybe putting up plants abroad, instead of taking money from India, I can borrow ECB and use those funds in maybe creating a plant in Dubai or creating a plant in Malaysia. Other aspects would include monitoring of inflows and outflows. So in a large company where you have two divisions, export division and import division, but they never talk to each other. Today morning, I got $1 lakh, I have converted at 83.50. At 4 o'clock, somebody says that there is a bill due. You send the documents to the bank. Outward remittance is there, $1 lakh. Now, at 4 o'clock, somebody has converted the rupee into dollar at 83.70. What is happening? We are not talking to each other. So monitoring of inflows or outflows is necessary. I must know what is my outflow, when it is there, whether I can defer that outflow, prepone my outflow for a day or so, or if inflow is there, can I defer that inflow conversion for a day or so? All those things will matter. And if it is to be done on the same day, can I do a matching remittance or a cross remittance by even parking it into EFC account on the same day or not? Net off, set off, we have discussed, borrowing and we have discussed. And anticipated exposures. My business is a running business. Every month, $1 lakh less there. Whether the order is there, the shipment has been made or not, irrespective of that, I am expecting every month $1 lakh. So can I forecast it and maybe sell some part of it for next 6 months, 3 months? If I know that, or if I'm able to gauge that the dollar rupee is not going to go beyond 84 at any time. And then lastly, the hedging tools, forward contract options and future. Gross or net. Now, whenever I am using hedging tools, I have to see whether I want to book forward contract, export separately, import separately. So maybe my total imports in this month is $1 lakh and exports are $1,20,000. Should I book separate contracts based on the tenure, or should I book only 20,000, which is the net exposure, and even for futures and options. So we'll see what it is. Now, when we talk of exchange rates, spot is more volatile. So what I'm doing today, my today's rate is more volatile than the forward rates, because forward exchange rates will always move according to interest rates, and interest rates are not that volatile than the spot rate. Spot rate ticker is every 3 seconds, 4 seconds. When we talk of forwards, the currency which has is costlier in future, which has got a lower interest rate. So dollar interest rate is 5.5, rupee interest rate is 7.5. Dollar is costlier in future. Rupee is at discount because it's higher because of the higher interest. So I also have to see the movement in exchange rate, but also the anticipated movement in interest rate, because it will impact my premium discount if I am booking a forward. Now, what is actually a forward contract? It is a binding contract between two parties. One is a user, ideally, and another is a bank. And it is made to order. It is a specified price, specified future date, or a range of dates. So I can book a forward for 12th September, or I can book a forward contract from 1st September to 30th September, Indian scenario particular, where I can deliver the currency or maybe get the currency from the bank at a fixed price, which is price fixed today, on any day in September, right from 1st to 30th. So what is it? It is an obligation on the buyer as well as seller. Given date or range and binding on both the parties. This is OTC, made to order. I can book a forward contract for 39,450.60 cents. But on the contrary, if I go for an option, it is not binding on both the parties. Forward contract is binding on the both. The option is what? When somebody is taking an option, it's a right to buy or sell. Right to buy or sell, but not an obligation. So as an exporter, if I buy a right to sell dollars, if I buy right to sell dollars, then in that case, I have got a right. So if I have an option to sell dollars at 84 in the month of July, and the dollar rupee is 84 or 83.50, I will exercise my right. But if it goes to 85, I will not sell dollars to the option. Under the option, I will sell the dollars in the market. So it has given me a right, but not an obligation. Now, this is what it is, an insurance. I have got a downside. My upside is still open. And for that insurance, I need to pay premium. However, the person who is giving this right or an option writer is under an obligation. A bank or an exchange or an institution which is giving a right to the buyer who is paying it, because I am getting a premium, so I have given. So it is just like our insurance. Insurance of a car or insurance of a scooter or a fire or theft. Now, futures are similar to forward contracts, except that forward contracts are traded or quoted are an OTC contract. The bank will quote. But future contracts are standardized and are traded on exchanges. Here, there is no 39,450.60. Here, either it has to be 39 lots or 40 lots if it is a $1,000. So it is all lot size, fixed delivery date. I cannot have 1st September to 30th September. If I want to book a contract for September, it will be last Thursday of September delivery. So everything is standardized, the lot size, delivery dates, and period. In India also, futures contracts are there and the lot size is $1,000, and it is weekly contract, monthly contract, 3 months contract. Now, when I talk of strategy for risk, I must have a corporate risk policy for entire risk of the policy of the corporate or the business house, right from fire, theft, security, movement in prices of raw material, maybe credit risk related, securities, all those things, and one of those will be exchange risk. One of the risks. Now, exchange risk, when I talk about whether I want to do it only purely as a risk management tool without looking at additional earning from it, Or if there is a large corporate, say like Reliance or Tata, who have their own dealing rooms, they look at risk management as a profit center. The department or the production unit or the export unit has quoted a price by taking 83 rupees 50 paisa today's rate. Now the profit centers work or their job is to increase the margin and try to get more than 83.50. Export department will have their profit margin of say 10% in 83.50. And if I am able to get 83.70, then that 20 paisa is the additional profit which the treasury had generated for the company. And here I will have to put risk control limits, benchmark levels. I will not book below 83. I should get not below 83.50, etc. All those things. And this needs to be assessed regularly on a monthly basis or by way of certain Excel spreadsheets or accounting. Also, there could be maturity gaps. If I am doing futures, I will have to book for say last Thursday of September. But actual due date for my export bill is 15th of September. How do I do it? So I'll have to manage those plays and the differential say on 15th and last Thursday, etc. How do I do it? What is the benefit of this policy? It will give me a path by which I can draw clarity of actions. There is a highway which has been constructed with various boards. Here is a speed breaker. Here you can increase your limit. Your on a highway, your limit of speed limit is 80 or 60 somewhere. Then there is a bridge, there is a school, there is a turn. All those signs are there in that policy. Because of that, it gives us clarity to move in the path it is desired by the management, and stability in the profit loss. If I have a policy, I will decide that I will not book. If the currency is going below 83.50, I will book a forward contract and take whatever I'm getting. And also losses, how to book losses is an important aspect there. Secure my margins. Whatever 10% is margin there in 83.50, I must not lose out of that. The last and important aspect is that you are into chemical business or you are into plastics business, you are into engineering business, you are into garment business, you are into maybe steel, anything of that sort, gems and jewelry. A businessman is more proficient in his own business, trying to get 1 or 2% more margin by better negotiation or better cutting of cost in his own trade. Foreign exchange is what? An additional risk which is being thrust upon the business because you are doing international or cross-border trade. Better to concentrate on business and act as per the policy or hedge your flows so that there is a peace of mind. If you are not able to realize your profit margin in that 83.50 rate, what I was giving as an example, then you lose your peace of mind. You take undue forwards or you use undue not required tools in such a way, because there is a mis-selling also at times. And maybe a couple of years back, we have seen that in smaller towns or export hubs, people have burned their maybe entire business out of it by booking forwards, range forwards, etc. in such a way that they have sold forward for 5 years together and booking losses in crores also. So beware of that cross-selling. Go as per the policy, take help of people, consultants, experts from the banking sector, and see that you are not driven to some taking additional risk, because your risk is your business and that should be there. Mark to market, daily, weekly, etc. Now, the strategy could be hedge fully, partially, keep position open up to certain period, use of foreign currency deposit accounts, borrowing in foreign currency, protect base rate and stop loss rates, and FX exposure as in profit center. This all will depend on the risk appetite, understanding of the subject, knowledge available of trained manpower, the infrastructure available, and if it is not there within your company, you can take shelter or take help of advisors, maybe at a fees, because it is as good as having a person in your office remotely helping you out in booking rates or guiding you on this thing. A couple of more charts on pound rupee. 1 month volatility moment is 1.55%, going from 105 to 107. On the ruble rupee, 1 year is 5.27%, and dollar rupee, 5 years is 20%, 19.59. Now, this does not mean that dollar is weakening by 4% every year. It is not uniform for every year. And to compare with this, 1 year chart shows 1.43%. So out of this 5 years, if you reduce 1 year, so in 4 years, it has gone 18% or so. So we will take the questions at the end of the session. These are my details. If maybe please you can take
Thank
down.
you, sir.
And I'll be glad to take any questions after the presentation, or maybe if somebody contacts me later on, I'll be glad to take the questions. Thank you very much. Thank you, sir.
Thank you, Mr. Warren. Thank you very much. I think you have covered the risk factor. Very risk factor you have covered. Whether you talk about the tariff risk or a shipping risk, or you talk about the country risk, or to talk about the IPR, or documented legal risk, or foreign exchange risk. What you have mentioned, I think, very more important. Don't put in one basket. I think this is the most important aspect. Is there any risk? You should not put in one basket. I think that is the mantra which you are given. And you must see the country rating before you are giving any exposure. I think you have taken into full respect whether you are talking about the perspective and birth, anniversary, and death. I think these are the important aspects which you are talking about. These four factors are more important. Once you are taking a order, that means you are negotiating for the price. Once you have negotiated and issued the accepted the export order, that means you are in the race for that export. That means you have to see everything before doing all something. I think we have covered very nicely as they are talking about the country rate, ECJC, and we are talking about the other aspect, how you can mitigate your risk. And we are talking about the hedging. I think that is the most important aspect. Here we are talking about the forward contract. We're talking about the future contract. And we are talking about the option. I think that is the best tool. So I'm coming to Mr. Madam from the ICICI Bank, Saranya ji, from ICICI Bank. Mr. Saranya, you are there. Do I have any view on that, Mr. Saranya, from the ICICI Bank point of view? Madam Saranya.
Yes, sir. Hello. Yes, sir.
Hello,
We
madam.
do have. I
Have any view
have
on
a small
that? What
presentation.
Warren
Can you
has
hear me, sir?
covered? You can put any addition to the ICICI Bank perspective?
Yes, sir.
Yes,
I do
madam.
have
Please
our
go
views.
ahead.
So, sir has covered on. Yeah, sir has
Madam,
covered
I'm
in
not getting
detail
you.
on
Please.
all the risks. And 1 minute, sir. Sorry. Just a minute.
Yes, madam. Please. Anything you want to say, madam?
Yeah. Am I audible now, sir?
Yes.
We are listening to you. Please go ahead.
Yes. So, sir has covered in detail on all the risks which are involved in both and in trade. So now I would like to cover on this exchange earners foreign currency account. So how we operate this foreign currency account, EFC account, as well as the special foreign currency account. I have a 5 minute slide which I would like to take it forward. So can I take it, sir? Hello.
You can take you can
Yeah.
begin.
So, so one of the points I was sharing was on the EFC account, that is the exchange earners foreign currency account. These are all current accounts which are maintained in the AD bank. But here in these current accounts, it is on the foreign currency, and there is no interest here. The way we do not get any interest in current account, even in this foreign currency account, there is no interest involved. So here, who and all can open these foreign currency account, that is exchange earners foreign currency account? Any resident or any firm, any private limited company or LLP company or any registered entity in India can open this EFC account. So any exporter or an importer can open this EFC account. Now we have two types of accounts. So one is EFC accounts for customer who are not in SEZ zone, and there is a special type of foreign currency account which we call it as SFC account for customers who are in SEZ zone. So we have two types of account. One is for customers who are outside SEZ zone and those who are in SEZ zone. So now what are the advantages of having an EFC account? One is I park whenever I receive an inward remittance in dollars. Let me say I receive an inward remittance on a Saturday, which is a $50,000. So I park it in the EFC account. So today I will not be able to do the conversion, but yes, I can do the parking in the EFC account. So I park it in the EFC account and I can monitor the rates in the next 1 week, and I can do the conversion at that particular time. Second, whenever I have a future obligation to be made. So I have a $50,000 outward remittance payment against my import in the month of August. So I can earmark this inward remittance which I have received and I have parked in EEFC account against this outward remittance. So on the day on August 5th, when I wanted to do an outward remittance, I can go ahead and I can remove the earmarking and I can make the payment. Now this fund which is there in the EFC account, I can also do a hedging against this account. So my entire fund gets credited on the day one in my account, but it is in foreign currency, and I have a choice to choose the rate or the day when I wanted to do the conversion. So if you could see, all these things can be done through digital platform. We have this digital platform called Trade Online. So once you receive an inward remittance, a customer receives an inward remittance, customer can park it in EFC account by few simple steps. So one, with access through their corporate internet banking or through InstaBiz, they can just settle it, give the purpose code, and they can park it in the EFC account. So it is a simplified process. And second, whenever they wanted to do a conversion from EFC account to the current account. So I would need an immediate fund on Friday and I have blocked the rate. So with that particular deal ID, the conversion happens from EFC account to current account instantaneously. So now there are multiple currency EFC accounts. So with EFC, we have 24 different currencies. So who and all can open EFC account? As I said earlier, any resident in India who are registered in India can open. So somebody who is located in SEZ unit, customers who are operating out of SEZ unit having a letter of approval certificate from SEZ can open an SFC account. So we have 24 currencies in which EFC account can be opened, and SFC account 18 currencies it can be opened. And since the existing current account is already available with us, opening an EFC account is a simplified process where we would require an additional document BR to open
Yes, madam.
account.
Lost your
and
now
voice.
I receive an inward remittance today. Month end, this amount has to be, it will go for a post conversion. Is it fine now, sir? Hello?
Yes, it is okay. Carry on, madam.
Yes.
Yeah. So, yeah. Uh, so I would like to take up on this mandatory conversion. That is, whenever we are receiving an inward in today, or let me say I have received an inward remittance in the month of June. So this month I have received an inward remittance now by subsequent otherwise this will go for a 4. So if I receive an inward remittance on 28th of June, still by July end I will have to do the conversion, even if I receive in this subsequent month end and it is not 60 days or 45 days. So now let's see on the currencies in which we can open the EFC accounts. So these are the 28 countries where we will be able to open the EFC accounts. So we have wide range where we start from dollar, euro, GBP, which are the general ones. And we also do have New Zealand dollars, Norwegian kroners, ZAR, that is South African rand. We have Swedish kroner, Thai baht. We have Korean won. We have. So these are the wide range of currencies in which we can open the EFC account. And now, what are the permissible credits and debits in the EFC account? So, in case of permissible credits, I can receive my export proceeds and I can credit it to my account. I can also receive my service payments. So, my service payments will be for consultancy, management consultancy, or a lecture fee if I'm an individual who is having an IE code, and any kind of inwards which I receive as a proceed for my foreign services or export of goods or export of services are allowed into this account. I can also receive payments from another SEZ unit. And if I am an SEZ unit, I am in an SEZ unit and I am holding a SFC account, then it is also permitted to receive dollars from a DTA unit. So these are all the permissible credits which I can receive in my EFC account. Now, what are the permissible debits? So as we discussed earlier, I can make payments towards my import. So either it is goods or it is services, I can make a payment from this EFC account. In case if I am doing an investment abroad, I am going to do an investment in US wherein I am buying shares of a company. So this ODA, for this ODA transaction, payments can be done from the EFC account. I can also make payments to a STP unit or a DTA unit. If I am in an SEZ unit, I can make payment in dollars to a DTA unit. And in case if I am doing business with an EOU unit or customer who is in SEZ unit, I can also receive payments in dollar from them, as well as I can make a payment to them. And any kind of capital account transactions, for those things also I can do payments from my EFC account. So these are the permissible credits and permissible debits from EFC account. So now, whenever we think about hedging tool, one of the prime thing is we will have to secure our profit. It is not that we are going to play with the market, but my intention, our intention as a customer is to secure the profit. So here, one of the tool which is very important for a exporter or an importer is the foreign currency account, which he has to maintain so that it is easy for him, or let me say uh, it is very viable for him to maintain this. At the same time, he can view the market scenario, he can view the ups and downs of the market, and at his comfortable rate he can do the currency conversion and he can do the credit to his account, and he can also make payments from his EFC account so that the foreign currency conversion, double time foreign currency conversion, is avoided. So one of the best tool or best account to open is an EFC account, and with ICICI this opening is very simplified process, and all this can be done digitally itself. All transactions, settlement into EFC account or payment from EFC account can be done through digital mode. So this is what I would like to
Thank you, madam.
convey in this thing. Thank you, sir.
Thank you, madam. I think you have told very nicely. EFC account, you can, any exporter who is earning the foreign exchange can open the account with the ICICI Bank. And it is beneficial for them because online also you can open the account and you can have a permissible credit and debit, what madam was talking. I think in 24 countries, risk about you're talking about, that you can open the account in 24 countries with ICICI Bank, which is very beneficial for the exporter. Any entrepreneur who are listening to us, or even any banker or our members, are interested for any questions to be raised to these two panelists, Mr. Gaurang, who is expert in the risk management of the foreign exchange. So we are happy to give any reply. I could not see any question till this time. So point is, now I am requesting Mr. Gaurang, have any advice to our listener, Mr. Gaurang, to cover the risk factor. You are talking about the risk factor, even buyer by credit, other things you are covered. Whether risk can be covered for any financial loss to the exporter. Any policy can be issued to the exporter or importer where the financial loss can also be covered. Mr. Gaurav, or any view, Gaurav, so that they can be beneficial
Yes, sir.
by our entrepreneurs.
So, sir, when we talk of, very rightly said that when we talk of the financial risk to the exporters or importers because of the movement in exchange rate, they should by themselves try to see that how to minimize the risk, and if a good opportunity is available or a better rate is available than their costing rate or a bid rate or a rate at the berth, then my personal view is that always they should go and book forwards. This is for smaller exporters, particularly. Larger ones, if you talk of large corporates, they may be having their own dealing rooms, they may be having their own setup. Their risk appetite is much, much more than our SME segment, what we normally target. Try to hedge risk, try to cover those things.
The point here, Gaurang, is
Yes, sir.
for any exporter, whether their profit risk can also be covered.
Sorry, sir, whether?
Their profit risk. Point is, when he could not export the goods and something happened to them for exporters,
Yes, sir.
or a money is stuck up with the buyer. So how it can be covered?
So if there is a risk of contract cancellation, then there is a separate risk that needs to be taken care of by way of creating certain parameters in the order itself.
Any view for that cancellation of the order?
Cancellation of order is normally not covered.
ECGC is giving them any guarantee for
No,
that?
sir. No. ECGC
Even
does
advance
not.
payment guarantee they have issued.
ECGC does not cover
Payment
cancellation of
guarantee,
order.
or you can say other guarantee, performance guarantee, something like that. That can also be covered by the ECGC.
ECGC does not cover exchange rate risk, sir. It covers the risk of the exporter on the credit side of the buyer. So if there is a due date bill, say 90 days bill or something, then ECGC will cover it. For the banks also, ECGC covers the pre-shipment part. But for exporters, it is only the buyer-wise policy.
I am talking about the post-shipment.
Post-shipment, yes, definitely. Post-shipment, once the shipment is made, then it is covered under ECGC, but not prior to shipment.
Okay. It is
So that is why that construction of an order is more important up to the stage of shipment at least.
Any policy is available in the market where the profit risk is also covered?
No, sir. I am not aware if the profit is covered. But normally what happens that if our 90%, up to 90% of the value of the goods are covered by ECGC in case of SME.
Yes, sir.
So 10% still, because it is all the insurance on the credit side are co-sharing parts. It's a risk-sharing policy. Even the policy which is issued by New India Insurance is a risk-sharing policy.
I am talking about that policy. What is that policy? You can explain something to the our listener.
Yes. So the policy which
Something is there.
ECGC or any credit risk insurance company would issue is a co-sharing or a risk-sharing policy. And that policy is where you need to pay a premium either on your each consignment or entire turnover, or maybe multiple consignments to a buyer, or multiple buyers in a country, or multiple countries, multiple buyers. Any combination of policies can be taken. So when you take a policy from from a company, insurance company or ECGC for that matter, they will prescribe and tell you that what is the worth of the buyer, how much exposure you should take. So for that, each buyer, they will give you an exposure limit, and that acts as a support to you for expanding your business or not expanding your business with that particular buyer. And there is also a condition relating to tenor of credit, with 60 days credit, 90 days credit, 180 days credit, terms of contract, etc. So ECGC or the other credit insurance companies help us as an exporter to create our own environment in understanding the business flow to a particular buyer or to multiple buyers across the globe. And that is why when I was talking for credit risk, I was trying to emphasize that we can always resort to ECGC to check out that whether I should do business with this buyer or not. If I want to do business, then what terms should be there? Whether I can send it maybe $5 lakh in one go for a first time buyer, etc. These things can be there. And the premiums are maybe ranging from 0.5% to 1.5% or so, but that is worth of it. Because ultimately, by paying 1% on an average premium or 0.75% premium, you are secured at least up to the 90%, 85% of your risk which you are taking on a buyer.
Madam Saranya, so whether from ICICI Bank, whether what you can advise to our entrepreneurs who are listening to you, from ICICI Bank point of view, what is your advice to these people? Saranya ji, Madam Saranya.
Yes, sir. Sir,
Any
one thing I
advice
would.
to our entrepreneurs who are listening to you?
Yeah. So
Any
whenever
advice
there
to
is an.
them?
Sir, am I
Yes.
audible?
Yes.
You are audible. Please carry
Yeah,
on.
yeah. Sir, with respect to the transactions that I have seen in the past couple of years, one thing, as said by Gaurang sir, what we'll have to check is on the buyer. So checking on the buyer either through DNB or a third party or through bank also does the checking through the DNB with the help of DNB or other partners. So that has to be checked first. And once we do the shipment and the payment is not received, there are set of guidelines, set of things to be followed. So first thing, customer has to report in the embassy of the country. Indian embassy provides that, because even if we go for a write-off with RBI, so first thing what RBI seeks is what is the steps you have taken. So even before, when we are identifying a buyer in a
Okay.
particular country, we will have to check all these things. So whether there is
Your
an
voice is
established
audible, madam.
agent.
You're okay with any question from your side? Any advice from your side? Yeah, I'm getting you. Tell me.
Okay. So
Hello?
we'll have to while identifying the customer itself, we will have to
Okay.
ensure, we will have to check the background both on the country as well as on the party, and if there is any litigation in the future, whether we will be able to handle it. And we can
See,
also.
my point is different because ICICI is conducting this program jointly with the and our associations. How ICICI Bank can be help to the entrepreneurs? Why they should come to the ICICI Bank? What type of further facility you can provide these people so that you can get some business from these entrepreneurs? That's the point.
Yeah. So if that is the one, then we do all these transactions through digitally. So now all transactions, customer need not come to branch and submit the document. We have our digital platform, which is one in kind in industry, which is called Trade Online. So no documents need to be submitted in the bank, or customer need not run for it. So once the submission of document is done through TOL, everything is automated. So once transaction is also done, customer gets an automated mail on the mail of the wire which has been sent. The SMSA wire Swift is being received in their registered mail ID, and they receive the SMS also. Similarly, when they are receiving an inward remittance, they will be receiving a mail stating this inward has been received from so and so party. So all these things are digital now and it is automated with ICICI. And with respect to lending part also, we do both type of lending, that is collateral as well as for non-fund based, which is FD backed, that is LC and bank guarantee can be done, LC backed. And packing credit, with respect to packing credit, EPC, we do instant disbursements. So this is streamlined and all these things are now done digitally. So both on the lending side as well as on the business transactions, it is all completely digital now, and without any hassle, customer can do it paperless.
For any post-shipment credit, you can give without any collateral security.
Yeah, post shipment facility, we have EBN where we have lines, credit lines with the other bank. So if it is backed by LC, we can do the export bill negotiation post acceptance, sir, without collateral.
Without collateral. Thank you very much,
Without.
madam. I think you have excellently covered. I am thankful to you on behalf of the Association of Research in India. I think the message must have gone to the entrepreneurs who are listening to you and to our members also that ICICI is very aggressive in financing the export. And all they are their friends, and you can approach the ICICI Bank for any type of assistance. Thank you, madam. So, Mr.
Thank you, sir.
Gaurav, sir, I think you are excellent in your advice to the risk sector and hedging and solutions providing to our entrepreneur. Lastly, anything you want to say to the entrepreneur which is beneficial to them in a few words? Anything you want to say, Saurang sir? Gaurav sir, sorry sir.
Yes,
Anything
sir.
you want to say, Gaurav?
I just want to say that the spirit of entrepreneurship should continue, and we need to increase our exports, uh, be safe, and do business in the proper manner so that we are able to bring good laurels to the country also, and you are also able to build up your own bottom line. Maybe now everything is digital, so as Serena said, that you should look at the compliances part also. When you go to a digital bank, it's more easier for you to handle compliances on the other side also. So with the technology evolving, I think this all will go to a long way. And wishing all the best to the entrepreneurs and the participants.
Thank you, Gaurang. Thank you, madam. I think we have covered very nicely all the point of solution for hedging and managing the foreign risk. And ICICI Bank is playing very important role for negotiation of the bills and helping the exporters. Even for importer also, they are helping a lot. And any entrepreneur who is feeling like that, they can approach the ICICI Bank, and definitely they are helpful to these. Any difficulties envisaged by them. So Research in India, we are also here. And a Research in India, we are a merchant banker and we are investment banker. And we are also providing DPR, and we are also conducting technical economical viability study for all the banks. Most of the State Bank of India and other PSU banks, we are also doing it. Any DPR other thing is required from the Research in India, so we are also helpful to them. And being an association of the financial advisor, we are the, you can say, bridge between the banker and between the entrepreneurs and between the financial advisor also. So if we are a financial advisor, so you can become our member of the association. We are more than 400 members at present. So anybody listening to us, they can also be our members for the associations. Besides that, they can avail the benefit of the all hedging and forward cover, even a future option with the ICICI Bank and other banks. For that, in the end, I'm thankful to the ICICI Bank, especially Madam and Mr. Gaurang sir, who has rightly covered all points which we have kept in a agenda item, key agenda item, which we have circulated in our web for this virtual webinar for that. I'm also thankful to of the screen, my friends, Mr. Ayush, Mr. Rajan, Mr. Lokesh, and Devashish, and all people who are off the screen. They are not coming on the screen, like they are the main architect of this webinar, who is helping me to conduct the webinar smoothly. So lastly, I'm thankful to all my participants who in all webinars give us a blessing. I think for today webinar, no question was available. Still, any participant feel, any entrepreneur feel, any question which they cannot write or they cannot envisage it, please write to us So we'll pass on to the ICICI Bank or to a expert of Mr. Gaurang sir, who can give you proper advice for your benefit. With this word, I'm thankful in closing session, although season is very good, where I am here for my outing, for my research in India, our Bombay teams, I am with them. Still, we have got a time to interact because I know the importance of this webinar so that we spare our times and during my holiday period also, so that my entrepreneur for the participant can be benefited for that. Lastly, I'm thankful to ICICI Bank who is giving a boost to us, who are giving confidence in us so that your business can be grow under all fields. As we have also conducted for SME sector, now we are done for exporter also. So anything, other things from required from the research in India or from the association, we are helpful to them. With this, I close this section with my thanks to everybody. Thank you very much. Thanks, sir.
Thank you, sir. Thank you, Gaurang, sir.
Thank you.
Gupta ji.
Thank you, Gupta sir, for leading this seminar in spite of your busy and hectic schedule. Thanks to all the speakers for their valuable inputs to the participants. Thank you once again.
Thank you.
Thank you,
Thank you. Thank you, Rajan. Thank you very much.